right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by CNBC's senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. Been a busy week.
Very busy. How are things going for you?
Good. I'm about to go on vacation for a few days, Thanksgiving things. So I'm looking forward to next week.
Yeah, me too. So let's jump into all of the latest news on the market. So first things first, Bob, can you just kind of tell us what's been driving the market?
Well, again, this week we saw really there's three themes that matter. This year has been very much dominated by big macro issues. What's macro? Macro means stuff outside of individual companies. Companies run their businesses. They have CEOs. They have ideas. They have competition. But that doesn't necessarily determine what happens to companies. Sometimes there's bigger issues. We call them macro issues dealing with the global economy that affect the companies, but the companies have a hard time affecting themselves. So there's three things, macro themes, that have driven the stock market this year. The first is the Fed and inflation. The second is China and the lockdowns they've seen in COVID. The Chinese have adopted an attitude that almost any outbreak of COVID has to cause a lockdown. Causing various problems with China's economy, which is the second largest in the world and affects things like commodity production, for example. And third is the Russian invasion of Ukraine, which has caused a very difficult problem with Europe and the economies of Europe. So things have gotten a little better on all three fronts, and that's why the stock market's been rallying recently. So on the Fed and inflation, Mr. Bullard notwithstanding with his strange scenarios in the last few days, generally the picture is that the Federal Reserve will probably top out raising rates in the first quarter of next year. Exactly what the end rate will be is not clear. Right now it's 3 3/4. They'll raise it. The current consensus is they'll raise another 50 basis points in December. That would bring it at 4 1/4. And maybe they'll do another half point or so rate hike in the first quarter of next year. There's a few meetings in the beginning of the year. And then somewhere around 4 3/4 to 5%, somewhere around there. And that's the current consensus. The concern is rates might stay high for a longer period before they start cutting them. That's all subject to debate, but that's the current consensus right now. On China and COVID, they're showing some signs of being more realistic. The Chinese will hack away at this in a very slow way. Now they're saying the period of isolation is not 7, it's 5 days. They'll cut that down again. They move in slow increments. The point is, they're starting to adopt a more realistic attitude about COVID. The third is the Russian invasion of Ukraine. And here, just the fact that the Ukrainians have held on. Remember in February, everyone said, well, the Russians are going to be in control of Ukraine in a month. Well, not only they're not in control, they're losing ground. The fact that the Ukrainians were able to claw back Kherson was a huge victory. How much more they're going to claw back, but the Russians are now openly talking about negotiating. That's a good sign. It's not an end or anything, but this is moving in the right direction. It's not clear when it's going to end. It's not clear. We might have a long slog. It's not clear. They might try to, simply pull out or stay where he is and just hold on. But they are making signs they want to negotiate. So that's good. As a result of all of these things, these three things, the S&P has risen in the last month. We're up about 4% compared to where a month ago. So that's a big move. Now, we need more meat on the bones for the most important thing, which is the inflation story. We need to keep hearing inflation's moving in the right direction. The CPI, the Consumer Price Index, was lower than expected when we had it out. So instead of an 8%, we're talking about a 7% year over year in terms of inflation. That's still too high but at least it's moving in the right direction. And that's all we can ask for at this point. Keep moving in the right direction. So every data point that we get that indicates inflation is receding is good. The market really welcomed news that mortgage rates were coming down. They were over 7.5%. They're now in a 6% range. Okay, still too high, but that's moving in the right direction at least. So that's what we're dealing with right here. A lot of hopium, frankly, that inflation is moving in the right direction.
Well, so Bob, let's dive in a little bit deeper into the Fed. Like you said, we had some hawkish comments this week. So is there still hope for a soft landing, and what would that look like?
Well, yes, there's still hope for a soft landing. In fact, Goldman Sachs had a note out this morning. Surprisingly, they said that's their base case scenario. By the way, very fuzzy. What's a soft landing versus recession versus a severe recession? But generally, soft landing is good. Soft landing would mean that, for example, job growth is still there, but not as robust as it used to be. So it won't be as easy for people to just leave their job and immediately get another job, but it won't be a desperate situation. Mortgage rates might come down a little bit more. Housing will stabilize a little bit more. You won't get big price increases like you have in the last few years. Things will just slow down, but not dramatically collapse. So that's basically the idea here. I think the problem is the Federal Reserve officials are terrified of high inflation being like 8%, because when you have it persist for long periods of time, it's really bad news. You can't get wage increases fast enough. So 4% wage increase doesn't mean you get 8% inflation. People start demanding more, and you get a cycle where all of a sudden it just keeps going and going and going. It becomes recurring. And that is a real worry for the Federal Reserve. You don't want high recurring inflation because it gets entrenched. People just keep routinely asking for higher wages. They keep routinely raising prices on everything, on chocolate bars and everything. And it just gets embedded in the economy. You want to break that mindset. And that's why you have the Fed officials being so aggressive, because they saw in the 70s when we had this recurring inflation, a very bad mindset kind of set in. Stocks underperformed, the economy underperformed. A little inflation is good. Too much inflation is not a good idea. So the only way they know how to bring down inflation is to keep raising interest rates. It's a very blunt instrument, unfortunately, because you can't fine tune anything. All you can do is raise interest rates, slow the economy, and they usually overshoot and cause a recession. So that's why Fed officials are so aggressive. They see the market, the stock market, which is their barometer of everybody's opinion and a wealth barometer, moving up again, and they say, oh boy, they think inflation's over, and we're going to start lowering interest rates. And they have to keep coming out and saying, I'm sorry, inflation is moving in the right direction, but it's not where we want it to be. It's still too high. So we have to be very vigilant. We're going to have to raise rates a little bit more. And yes, it takes a while to see the effects of these rising interest rates, but all we know is it's still too high. So that's why you get these hawkish comments. I call them these tape bombs. That's what they are. Bullard the other day is a Federal Reserve, voting member, one of the governors, one of the regional bank presidents. And he basically came out and said, well, I know people are talking about us stopping at 5%, but we could go to 7% under certain scenarios. Well, that's a lot. That's much more. So the market kind of dropped on this. I call them tape bombs. All of a sudden, Fed officials throw a bomb out there, and saying, you all thought 5% was where we were going to stop raising interest rates to. Well, maybe we'll do 7%. And that annoys everybody. After a while, you get exhausted hearing about, how can you top this from Federal Reserve officials? They might say 5, but I say 7. I'm going to raise it to 8 or 9. It makes people exhausted after a while. And the market tries to suss out where people really are and where the market is really going. And the current consensus right now is somewhere the Fed's going to stop somewhere around 5%. Now, again, if the inflation doesn't, if it doesn't work and inflation stays high, 6 months from now, we could be at 5.5% with the Fed terminal rate rather than 3 3/4. I don't know. But right now, the market thinks that's around where we're going to stop.
Yeah, well, inflation is certainly, bless you, inflation is certainly on everyone's minds, especially as we head into the holiday season and the end of the year. You can't really escape the high prices. So, Bob, next question. We got some earnings results from retailers this week. What are we learning from the retail earnings?
Well, it's a mixed bag. It's been very confusing, to be honest with you. And sometimes you just have to say it's confusing. So look at Target versus Walmart. So Walmart was pretty good. Target wasn't. Target said they're having problems. They see the consumer slowing down. They're having some inventory problems. Target and Walmart are not exactly the same creatures. Walmart is a sort of middle, lower end consumer. Target's kind of a middle consumer. Walmart has a different mix of products. They have a much higher contribution of their earnings from groceries, which are sort of a staple rather than discretionary items like, clothing and lawn chairs. Well, Target has more of those discretionary items. So to a certain extent, you could see certainly in the lower end, people not having as much discretionary spending and focusing more on staples like groceries. On the other hand, it's not clear whether Target is really accurate. The concern this week when Target came out was, oh my gosh, the middle income consumer is in trouble. They're starting to pull back on their spending rather dramatically. And maybe there are problems with Target itself, what we call company-specific problems. The reason people are wondering about this is if you look what happened in the last 24 hours, Foot Locker came out with very good numbers. They said they had strong momentum. They raised their guidance. Ross Stores, which is a discounter, beat, and they raised their guidance. TJX did well. Gap has been a terrible performer this year, but they beat on everything you want to measure, on comparable store sales, on earnings, on margins. So people are wondering, maybe this is not such a disaster after all. Now, the big problem with retailers now, particularly the apparel companies, is there's too much inventory. So remember, everybody last year was buying clothes because, well, they had excess money. Now, this year, everybody's going out. They're going out to restaurants and travel. They're spending money on experiences as opposed to products. So, of course, the companies that made these products over-ordered. So there's too much inventory. There's a lot of discounts out there right now in the clothing area, and there's going to be. So Raw Stores talked about a very promotional holiday season. Gap said increasingly promotional environment. That means they're cutting prices, and you're going to get some very good deals on T-shirts and basics. That's good for you, good for the consumer. But the market knows that. They've been discounting these retailers all year. So if you look what's happened, earnings estimates for the fourth quarter for the retailers, they're, as a group, 40% lower than they were a year ago. Think about that. The profits of retailers, 40% lower than a year ago, partly because they've had inventory problems, but there's been supply chain problems. Costs are a little higher. So their profits are lower and the profit margins are lower. So they've been cutting it. And the concern now is, well, maybe Target means we have to cut them even more, the estimates. And I'm not so sure about that. So I would say the consumer is holding up fine. There are definitely pockets of weakness, particularly on the lower end. But this earnings, I call it the earnings apocalypse, where all of a sudden we're going to have another cut to all the earnings estimates at the end of the year. That has not happened yet.
So, Bob, a lot has changed in the last couple of weeks since we last talked. What is happening with crypto? Can you kind of explain where things stand?
Well, that's a complicated subject. I want to make a distinction of what's going on here. And I've said this many times to you. I am a very big backer and a very big bull on the fundamentals of crypto, on blockchain, on decentralized finance, on smart contracts. I am a big bull on this because I believe that this is a disruptive technology. I believe that it has the power to significantly reduce financial friction. I think you can use smart contracts to transfer money, to transfer real estate, to transfer stocks. I think it has tremendous potential application. So I'm a big bull on the whole concept of blockchain, but particularly smart contracts. On the issue of crypto, on Bitcoin, I have said many times, people ask me about the price of Bitcoin. What do you think of the price of Bitcoin? I'm completely neutral on Bitcoin. I have no opinion on the price of Bitcoin for the simple reason that it has no intrinsic value. It doesn't have any value other than what somebody is willing to pay for it. You see these rock posters behind me. I think I've told you many times, I collect old 60s rock posters, Led Zeppelin, whatever, Crosby, Stills, Nash, and Young. These posters are very beautiful examples of psychedelia, and I cherish them and really love them. However, they don't do anything. They don't pay me a dividend. They don't pay me a future stream of earnings. They don't do anything. They just sit on the wall. They look pretty, but what are they worth? They're worth only what someone was willing to pay me if I would put it up on an auction somewhere. And I can make a guess because there is a little bit of a market for them about what they might get. But again, nothing. Now, people say that about gold as well. This is true of all collectibles. What about coins or stamps? They don't do anything. It's true. They're all collectibles. People say this about gold. And gold is not quite the same thing. Gold does have intrinsic value. So I got a wedding ring here. It's my grandfather's wedding ring. This can be sold for jewelry. This has industrial purposes. It's not quite true that gold has no intrinsic value. Also, gold has been used as money in the past. So what's money? Money has to meet certain criteria. It's a store of value. It can't just deteriorate up and down. And it has to be a medium of exchange. Gold has been used as a medium of exchange throughout the centuries. Is gold money now? Yes and no. You can easily exchange it for cash, but it fails on one aspect in that you can't readily go anywhere and exchange it for something. It's not a unit of account. So when you go to the gas station, it's $4.50 for a gallon of gasoline. It's not 1/2 gram of gold. It's not 4 potatoes, and it ain't 1 Bitcoin. Which gets me to Bitcoin. Bitcoin fails on every level as a currency, as money. It's not a medium of exchange. It's not a unit of account. And as for a store of value, something that goes down 75% a year is not a store of value. So I have no opinion on Bitcoin. Most people do not want to address the central problem of Bitcoin, which is for most holders, it's a get-rich-quick scheme. What it is. I understand the philosophical reasons Bitcoin was created. I understand some of the crypto libertarian arguments around it. Most people are not involved in this for crypto libertarianism. They're involved to get rich quick. And that is not a good way to have a long-term investment. So when people ask me about Bitcoin, I say, look, the only criteria you should use is what does it do for your portfolio? You have stocks, you have bonds, you have real estate in your house. You own your house. Okay. What does this do for your portfolio, this Bitcoin? Does it reduce the volatility of your portfolio? Because that would be desirable. I don't think so. It's more volatile than anything. Does it improve returns? I don't think so. I don't think it's proven to do that. So I think it doesn't particularly work in terms of why you want to have it in your portfolio. I understand why some people said put 1%, 2%, 3% because you never know, whatever. Okay, on that level, fine, take a risk. I understand that. But don't ask me to, make an argument for Bitcoin. Now, on this FTX thing, we have an additional problem here. This is not even a fundamental thing. This is not a thing about crypto anarchism or even get rich quick. Here we have a question of potential fraud, misallocation of funds. We have legal issues. We have a major problem because the FTX, not FTX US, but the other FTX, is not even in the United States. It's in the Bahamas. So there's a jurisdictional question here. It's not clear whether people can, legally get all their money out. If you were in a United States fund that was controlled by US regulators, if you were a major brokerage firm and you had money, you own 10 stocks at a major, say, a discount brokerage firm. Pick anyone out there, Schwab, for example, or or anything out there, any big name. If something happened to that company, your money is protected. You're not going to lose all your assets because you have a mutual fund sitting there. That's protected. In these funds, they're not. It's not exactly clear what's happened to the money and where it's gone. So this goes to the question of why we need more regulation, why we need regulators looking at this more directly, why we have this problem of international jurisdiction or lack of jurisdiction, and why this is a major problem for this. So people keep saying, oh, you know, blockchain is the securest way in the world for people to transfer anything. Well, it may be secure in theory, it is, but in reality, what actually happens is there's all sorts of fraud, there's all sorts of theft, and it's a crazy system. So whatever it's doing, it's not working. I understand the concept behind blockchain and, you know, verifiability of the blockchain. And I think it's a wonderful idea. But in practice, around the edges, it's not working. And we have to find a better way to clamp down on the international exchanges. I don't know how you do that, but JP Morgan exists in many, many countries. You can open accounts in many countries in JP Morgan, and they figured out a way to do what the banks have. I think the real simple problem is a lot of the community does not want any regulation. They love this wild, wild west. And no wonder, look at all the money that's been made and lost. Well, I think that's over. I think you're a little bit of a crazy person to get engaged in all of this, despite the fact that I love the concept. So this is maybe a watershed moment here, and everybody's sitting around waiting for a Bitcoin ETF. You can forget about it. It's not going to happen. If anything, people like Gary Gensler from the SEC, who've been very skeptical about approving a way to own and trade Bitcoin using ETFs, if anything, his skepticism has proven correct at this point. So I hope I've made myself clear on how I feel about all this. Wonderful technology, wonderful potential. The lack of regulation is creating all sorts of potential for fraud and misuse.
Yeah, well, it'll definitely be interesting to watch how things kind of unfold in this space and if we see more regulation here. So Bob, it's middle of November, kind of hard to believe that this year has gone by so fast, but it always does. And so I was just wondering, you know, what are you watching as we head into the end of 2022?
Well, the big thing is going to be how aggressive the Fed's going to be. I don't know if anybody remembers December of 2018, but we had a droop going in to December rather significantly. And that's because the Federal Reserve was aggressively raising rates, and not even close to what they were doing now. They were raising rates like 25 basis points at a time because Powell wanted to, he was raising rates. And the market drooped going into December rather significantly. And New Year's Eve, it was terrible. I mean, normally, December is an up month, traditionally, and it wasn't. And Powell sort of changed his tune in January of 2019 with rates. And there are a lot of bulls that are betting now that that's what's going to happen, that they're going to somehow acknowledge that there's an end point because they're going to see a very clear slowing in the economy, and all this hawkish rhetoric is going to go away. That's why there's so many people out there, essentially. That's why the market's up 10% in the last month. There's a lot of people betting that it's not going to be, the terminal Fed funds rate is not 7%. Right now it's 3 3/4. It'll likely go to something close to 5, and it's going to stop somewhere around there. Maybe that consensus is wrong. That has happened. But that's where the betting is right now, and you keep an eye on that. Normally, December is a great month, particularly after a midterm election. There's some very strong seasonal factors here. The market tends to rise in the 6 months after November. There tends to be an end of the year rally, and in midterm elections, there's particularly strong rally 3 months after the elections because you get certainty on the elections. So you put these seasonals together, it looks pretty strong, and the market has had a terrible year. So, you know, there's a lot of impetus for the market to go up, but the most important thing is how the Fed deals with interest rates and inflation. And if the Fed keeps aggressively going out, if this 5% ceiling that everybody has in their head is wrong, no, the market's going to go down more. So that's the problem. Where are you on how the consumer's doing? They want the consumer to slow down. They want the economy to slow down. They don't necessarily want any kind of collapse, but they've got to see some results. And that's what nobody can figure out. This is a blunt instrument. Nobody can figure out how much the economy is going to slow down. So figure that out, and I can tell you where the stock market's going to be.
All right. Well, thanks for answering all of our questions, Bob. I know I'm excited for the holiday next week, too. Do you have any Thanksgiving traditions?
My wife and I are going to go on vacation. We have had a tradition for the last decade where we go away by ourselves without our families. Our families have gotten kind of used to that and are not so mad at us anymore. And I just love spending a week with my wife. We've been together more than 40 years, and it's one of my favorite things in the world to do, to be with my wife.
Well, that sounds wonderful. I hope you guys have a great time. Happy early Thanksgiving, and we'll talk to you again soon.
Thanks, Katie. And thank you, everybody. Have a happy Thanksgiving. And remember, be positive.
Yeah,
it's still a great country.
Yes. Keep reminding ourselves, right?
Yes.
All right. Well, thanks, Bob. And thanks, everyone, for tuning in. Talk soon.